merry stock market. Oh, man. Woo!
That's something that never gets old, does it? Anyway, welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term bucklehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to do one of my favorite events where you and I go look at stocks together. 10x stocks. That's right. So what happens is I pull up Fidelity, my Elity, and I look up stocks one by one until I find a stock that I'm interested in that I will then do further analysis on. But in the meantime, while I'm on Fidelity, you can also post stocks that you like in the comments, and we can go ahead and analyze your favorite stocks together. Because you know me, I love individual stocks. I buy them all the time, bro. I'm not an index fund investor. So let's go ahead and look at some stoinks. So here we are. Make sure I'm sharing my screen. Here we are on Fidelity by Elity. And here you can actually screen stocks. Now, they have categories and themes here. Artificial intelligence, big data. I don't limit myself to any one theme because usually when you do thematic investing, you're probably just investing into a bubble because you know all the popular themes are the ones everybody's looking at. AI, electric vehicles, technology. I just like companies that are massively profitable, growing their revenue, and are trading below their intrinsic value. I know, I'm the most genius investor in the world. So let's go ahead and do some filtering here. So number one, I want common stock. I don't want REITs. I don't like REITs, real estate investment trusts. Why? Because they pay high dividends and they are actually pass-through dividends. They are ordinary dividends. Those are highly taxed, okay? Those are taxed at your marginal tax bracket. That doesn't matter, bro, because it's dividends in the future. Yeah, okay. Let's see. Market cap. I want small companies. Actually, you know, we'll do large caps too. Large, medium, small, and micro cap. I call them micro craps, but you know how it is. Some people like them. Let's do PE. We're going to do low PE stocks today. So it's got to be below 11. I don't know why it's 11.36. Whatever. Let's see. PEG ratio. What else do we have? Security price. No. Dividend yield. I don't like dividends, but I'm not going to filter those out because you don't want to miss over a good stock because it pays a tiny dividend. All right. Let's do PEG ratio. Very low, low, very low and low. That really narrows it down. And let's do price performance the last 52 weeks. Negative. So basically what we've done is we filtered out profitable companies that are growing earnings very quickly, that are trading at low PE ratios and that have sold off. So right off the bat, the first stock that pops up is Dell, my what the hell. So let's go ahead and look at Dell. Delicious definition. How much you want to bet this is a value stock? Let's see. Revenue. Okay. Well, their price to sales is like 0.3, 0.33. This stock is freaking cheap. Does that mean it's a good buy? Not necessarily. Net income, they're profitable. I like that. PE ratio 7, forward PE 7. So it has a very low PE, so I highly expect this is not a fast-growing company. Let's see. What does Dell do? Oh, I don't know. They sell and support IT solutions, products, and services. They have 3 segments: Infrastructure Solutions Group. Wow, that tells me a lot. Client Solutions Group, and VMware. Okay. Storage solutions, rack, blade, tower, hyperscale servers, networking products. They do all sorts of crap. Wow, they actually go into a lot of detail on this website. Now, if y'all don't know, I use stockanalysis.com. It's completely free. I mean, if they want to sponsor me, great, but I'm not going to be mad if they don't. So let's go ahead and look at the revenue by avenue, okay? So we go back, and we can see that Dell's revenues, we can start at like 2018. They started to decline from 2018, and then in 2021, they exploded. Probably because of the pandemic, I'm guessing, but we can go do more research. That's probably the reason that Dell's PE is so low, is because it's not a fast-growing company. I mean, Dell's been around for what, 1,000 years? Then they have Dells in the freaking during the siege of Constantinople. Let's go look at some profit metrics. Gross margin 25, 27, 24, 23, 21. That's not nice. You can see their gross margins are declining every single freaking year. Profit margin. Wow, they were unprofitable for a long time. They only turned a profit again in 2019. And okay, the profit margin went down in 2020, and then it went back up a little bit in 2021. If you were to model this company out, I would use a really low profit margin. And it's tough because for the last couple of years, they were negative. That's one thing I would look into, is why was their profit margin so negative? And we compare that to their free cash flow margin. It's okay. You know what probably happened was they probably had positive free cash flow because they had a lot of either depreciation or stock-based compensation. That's what I've noticed with a lot of these tech companies, like anything that's like technology related. They have lots of freaking stock compensation. I don't know why. That's how it is. That's why I don't like Fartbox, also known as Dropbox. All right, let's go look at their balance sheet. Balance sheet. All right, cash and cash equivalents of $14 billion. Okay. Total current assets of $54 billion. Total current liabilities, $56 billion. Oh my God. Their current and quick ratio, which is a liquidity ratio, is below 1. Generally, you want a company to have more current assets than current liabilities. Current assets are cash or things that will be converted to cash within a year. Current liabilities are bills due within a year. However, we can see that Dell has a massive deferred revenue balance. That is a huge part of their current liabilities. A deferred revenue is just they received money up front. They got paid cash up front. They just haven't earned the revenue. They haven't performed the service, whatever it is. And as long as you don't think there's going to be any cancellations, they're probably going to earn that revenue. That's going to be reversed out at some point. So overall, I mean, really, if you look at their accounts payable and current debt, it's about $33 billion. And they have, even then, that's a little crazy. That's actually a little concerning. I don't know if that's normal for this company, but they actually have fewer current assets than they do current liabilities, excluding deferred revenue. Let's look at the current ratio real quick. Let's see. Okay, that seems to be pretty typical for the company. Some companies have low current ratios, so it's actually not super alarming, but I don't necessarily like that, especially as we're going into a recession, for this company to have a current ratio below 1. Let's see. Debt to free cash flow. Looks like either their free cash flow went down or they took on a lot of debt because it went up. Let's go see. Let's finish up with the balance sheet first. All right. They got long-term assets of $47 billion, $27 billion of which is goodwill. Now, notice their goodwill has gone down. It could be intangibles too. But if it's their goodwill going down, that means they're recording goodwill impairment charges, which means they bought a company for more than it's worth. And then they later found out that the company wasn't worth what even the goodwill says it's worth. And so they wrote it down. There's a whole process to write down goodwill. But basically, goodwill is just a plug where you pay more for a company than it's worth. So that's going down. I don't know if it's intangible assets. It doesn't break it out here. But if it's goodwill impairment charges, I mean, do they show on the balance or the income statement? They do not. So that could be intangible assets, which is something totally different. All right, let's see. So their total long-term assets, they have $5.4 billion of PP&E. And how much long-term debt do they have? They got a lot of freaking debt relative to their actual tangible assets. Now, why won't this go away? My only question is, I don't know if they're using a lot of debt to buy intangible assets. It doesn't break it out here. But if they're using this long-term debt, down here, $21 billion, and then $16 billion of other long-term liabilities, maybe that's leases, I don't know. If they have all this debt and not this much property, plant, and equipment, that's concerning. My suspicion is they're probably using the debt to buy intangible assets. We'll see. So let's go look at cash flow, my ash flow. So cash flow, my ash flow. So we can see they've been pretty decently growing operating cash flow. That's actually one really good highlight of this company. Up, 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 up. Of course, they had a little bit down right here. That's fine. Let's see. Here we go. Share-based compensation. Jesus Christ. So it looks like their share-based compensation is what percent of their revenue? Let's see. 162 divided by. It's not that bad. So basically about 1.5% of their revenue is being expensed away to share-based compensation. Like I said, I don't know what's up with these stupid freaking companies and their share-based compensation, these tech companies. But the vast majority of their non-cash expenses are depreciation and amortization, which is going down, 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 down. Let me go look at the balance sheet again. Are they divesting of assets? Okay, it looks like maybe they had to write down some assets from 2019 to 2020. Something happened here with goodwill and intangibles. I don't know if this was a goodwill impairment charge, but look at that decline. They went from almost $60 billion of goodwill intangibles down to $29 billion. So like I said, I don't know if that was a massive impairment or what. That's why you have to do more research. Let's go look at some more ratios. So they're trading at a low PE. Their price to sales is low. Price to free cash flow is low. Let's see. I might actually be interested in looking into this company a little bit more. Because you can see there's a lot of metrics that are cheap, but there's always a reason why they're cheap. So this is something that I would definitely put in my back pocket, and I would reconsider at some point. But if I were to model this out, I'd probably have revenue flat or declining, and then I'd have profit margin at like 1 or 2%. I mean, this company is not very profitable, and they only recently turned a profit over the last couple of years. All right. Any questions so far? Any stock recommendations? Thoughts on CLBT? What is CLBT, young sir? Let's go look. CLBT. CLBT? Celebrite? Cellulite? What is this? Let's see. No revenue? Come on. So it's $1 billion company with no revenue. What's the price to sales on that? Infinite? Cellulite develops solutions for legally sanctioned investigations. Was this like a stalker company? It allows users to collect, review, analyze, and manage digital data with respect to legally sanctioned investigations, including, I'm not going to read that out loud, homicide, anti-terror. Okay, so this sounds like, a company that provides like software solutions to government entities, like police and stuff like that, to help them track down freaking. Why is my mouse going nuts? Did my freaking mouse battery die? You gotta be shitting me. Oh, there we go. Okay. Let's go look at the financials. Okay, they do have revenue. Okay. Yeah, you go back and look at this. It says there's no revenue. So that was really concerning there. Okay, they got growing revenue. Let me guess, they're unprofitable. Wow, they became profitable. Look at that. So unprofitable, profitable. Is that a one-time charge or what is that? Let's go look. Let's see. Or not a charge, but an income. Other expense income. Okay, yeah. It looks like in the quarter ended December 31st, 2021, they had some kind of non-cash gain. And that's why they showed such massive profitability. But at the end of the day, this company is, let's see. Pre-tax income. I mean, they're improving their profit margins pretty. Yeah, okay. There's some kind of non-cash gain going on here. Because you can see, look at their operating income. Extremely freaking small. But if you look at the bottom line and you skip the operating income, it's like, oh, they're super profitable. But they're having some kind of non-cash gain here. I don't know what it is, but it's making them look super profitable. It should actually tell us on the statement of cash flows. In the meantime, before we get there, okay, they're issuing shares. Maybe they just IPO'd. I don't know. Their shares are exploding, so you're getting diluted to kingdom come. Let's go look at the cash flow statement. Let's see. Yeah, they have negative operating cash flows. Like I said, there's some kind of non-cash gain that's helping this company look profitable, but they probably don't have free cash flow. They had 1 quarter of positive free cash flow, and that was it. So this is kind of like, a company like this could deceive you. Like, you look at the PE and it's like, oh, it's 7. Oh my God. But that's because they had some kind of non-cash gain, which doesn't necessarily mean that. That's not good for the business, or not good for you as the investor. You need to go look at the operating income. You need to look at, multiple lines of the income statement. Operating income, negative, barely profitable, negative, barely profitable. This is a very low margin business, at least at the short term. Let's see. We can do 1 quarter to kind of show you what the operating margin is. 4.31 divided by 67.91, 6% operating margin. So this company, eventually became actually profitable, not with these one-time gains. They would have to pay interest and taxes after this. So their profit margin would be 4 or 5%. I mean, is that really that great? I don't know. Let's see. Let's look at their cash and cash. They have $165 million of cash and cash equivalents, and they have $170 million of debt, mostly deferred revenue. And if you take their total liabilities, let's see, 336 minus their deferred revenue, they really have like true debts of total of $183 million. So from a cash perspective, they're actually doing pretty good. Like I would, if I'm reading this correctly, they're doing pretty freaking good, because a big part of their liabilities is deferred revenue, which, like I said, they just got paid up front, but they haven't performed the service yet. So I don't think they're going bankrupt anytime soon. Long-term liabilities, $166 million. And what are they using this debt for? What do they buy? Because look at all this debt. They have $166 million of long-term debt, and they only have $74 million of long-term assets, 37 of which is goodwill. That's something I would look into. Are they paying their short-term bills with operating cash flow with debt? Let's see. They better not be paying a dividend. Let's see. They had a tiny acquisition here. Yeah, it's almost like they're paying their short-term cash needs with long-term debt. That's at least what it looks like from this freaking website. I don't know if it's not feeding in properly or what. But yeah, this company, I don't know. I mean, maybe this is a company I would wait on. They really haven't, in my mind, showed the ability to be super profitable yet, or they're barely profitable, because you look at their operating income, it ain't that great. And it's just these non-cash gains right here. So don't be tricked into thinking this company's like, oh, it's so profitable. It's really not. And they're issuing shares left and right. And I don't know what they're doing with their long-term debt. So that's something you need to look into. Let's see. Any thoughts on my hard-on? Well, yeah, I mean, I'm shirtless. What do you expect? Let's see. What other stocks do we have here? Apple. Oh, everybody does Apple. Strongman. Why is InMode so cheap? It's weird, InMode. I think InMode is cheap because every single thing. This is like a medical device company based in Israel. You mad, Mike Stathis? They have like everything in their financial statements are like just beautiful. Like they have growing, massive revenue growth, profitable, almost no debt. Like it's like perfect. Like how could you possibly go wrong with InMode? And then you look at the valuation metrics, and it's cheap. It's super cheap. Why is it cheap? Maybe it's because some people have said this. Maybe it's because they don't have a lot of recurring revenues. So what they probably do is they probably like sell their medical device one time to a cosmetic surgeon, and that's it. They don't have another sale for 10 years. So, and also I remember looking, they didn't have a lot of research and development. So it looks like they're just sticking with what they have, which, could potentially be some kind of competitive disadvantage in the future. I think it's because their revenues, the market is pricing in their revenues are not going to be growing nearly as fast, or they're going to be negative. Maybe they've saturated their market. That's what I think. I don't know for certain, but when you have a stock that's that perfect and the freaking the PE and all that so low, Something ain't freaking right. So that's my thoughts. Open my schlopen. Let's go look. Open my schlopen. What is open? People Fufu does this, guys. Open door. Oh, jeez. So it's unprofitable. Okay, it's a 3.3 billion market cap. Unprofitable. What do they do? Operates a digital platform for residential real estate. Buy and sell a home online. Okay, this is like, this stock's probably gotten freaking wrecked because the whole real estate market's just been freaking annihilated. Let's see. Because, the freaking market, everybody went and bought a home and home prices went up massively and now we're raising interest rates. I mean, what do you think's going to happen to all these freaking home buying stocks? And this is just apparently facilitates people buying homes. Yeah, it's sold off 63%. Let's look at the financials. Boring. Yeah, what is going on with this company? Okay. They had pretty explosive revenue growth from 2018 to 2019. And then they had a massive decline in 2020. Okay, I can forgive that. And then an explosion in 2021. So basically, they just made up for all their freaking losses in 2020 because we all know what happened in 2020. Let's go look at the shares outstanding. Oh, my God. Oh, my God. Look at that dilution, man. When did they go public? Does this say when they went public? Just better tell me. Founded in 2014. That doesn't tell me when they went public. I mean, I don't know. This is one of those stocks where it was a massive beneficiary from the home buying frenzy. I wouldn't touch stocks like this, to be perfectly honest. I don't like companies or sectors that get caught up in these wild frenzies where their revenue explodes and all their profits explode. And oh my God, they're just buying, they're going to the moon. Because they probably overshot their intrinsic value. That's just my gut assessment. So, okay, massive share dilution. Look at that gross margin. Is garbage. Look at that gross margin. Negative operating margin. Negative profit margin. Massively negative free cash flow margin, except for 1 year. Let's look at the balance sheet. Okay, they got roughly $3 billion of cash. $4 billion of current liabilities. Uh-oh. So they have $3 billion of cash, 84 million of receivables, but they have more than 4.2 billion of current debt. So if they can't sell this inventory right here, whatever this inventory is, this company will go bankrupt or they're going to have to dilute. You can see it baked in. I mean, look at that. They have less cash than they have their debts that are due within a year. They're going to have to dilute or go bankrupt unless they can really churn this inventory. Now, what do they have inventory for? Are they buying and selling homes? It enables consumers to buy and sell a home online. It provides title insurance and escrow. Yeah, I'm just curious, like, what is their inventory? Like, how does this company have inventory? It seems like a service. So what's their inventory? Unless they're buying houses? I don't know. That's weird. Okay. Long-term assets, 166. Yeah, they basically have no assets. Look at that. 166 of long-term assets. Oh my God. Look at that debt. They got a lot of debt. I don't know what they used it for, but they got a lot of debt. Maybe to raise cash. Jesus. Oh my God. They went into massive debt. That's freaking crazy. Let's go look at the statement of cash flows. Okay. Massive negative operating cash flow. What did they issue that debt for? Let's look at the quarterly. Let's see. Okay. Then they paid off some debt. Okay, they issued debt. I'm trying to see what they used for this, what they bought for this debt. Okay, they got debt. It's almost like they're paying for their operations with the debt. I don't see any massive expenditures or uses of that debt. It's like they used it to raise cash just to survive. I don't like this company. I don't like it. I mean, look at the freaking cash flow is 2.3 billion. Let's see. Yeah, this company is in a little bit of trouble when it comes to paying off their debts. I mean, it looks like they've got rid of some of their inventory, but I would be scared. First of all, I want to know what this inventory is, and I'd be scared because if they don't sell this inventory, this company's going bust. But I guess they survived so far. So not my kind of company. Unprofitable, massive debt. I don't know what they're using the debt for. Maybe to buy inventory. Are they buying homes and selling it? I don't know. Interesting. Very interesting. Etsy. Etsy, my schletsy. I don't know. I can't rhyme like Lafufu does. I'm just a moron. Let's see. Etsy. This is like a soy boy website. All right, they're profitable. Good. It's a marketplace that connects buyers in the United States and Europe, which includes artisans and entrepreneurs. Isn't Etsy like a kind of like a gimmicky website? Like you want to buy like a stupid live, laugh, love thing. OMG, Etsy, yeah, Etsy, yeah. So I guess if you want to if you're a person that like a small business and you want to custom make stuff, is this a guy or a girl? Exquisite vintage and handmade Mexican fashions from the vintage Jesus. Oh, sexy. Okay, yeah, I think I'm pretty familiar with Etsy. All right, let's see. Okay, number one, massive revenue growth, massive explosive revenue growth. Why? Is it because of stimmy checks and lockdowns and people starting their own little businesses because they're locked at home and the only way they can make side money is to start a little business? I don't know. So they have pretty explosive revenue growth. Let's look at the gross margin. Okay, very high gross margin. So obviously, I don't think do they even have inventory or are they just a broker? Yeah, they're just a broker. They're just a middleman. They connect buyers and sellers. Usually, if a company has a high gross margin, they're probably not selling like physical products. I can tell you that. All right, so high gross margin, decent operating margin, decent profit margin. It's a pretty decently profitable company. Free cash flow margin is fantastic. Why is there a massive difference? Let's go look. Share-based compensation. Okay, they got some share-based compensation, but nothing insane. What is that? 139 divided by... Yeah, that's not really that crazy. Shares outstanding. They've been issuing shares at a pretty healthy clip. Let's see. I mean, this company looks like, on a surface level, it seems decently solid. Cash and cash equivalents. 987 million of cash. Okay, not many. Okay, they're not going out of business anytime soon. Total long-term liabilities, 2.5 billion. Lots of goodwill. Seems like they've been borrowing money to buy other businesses. That's what that tells me right off the bat. They have a lot of goodwill in intangibles. Let's see their statement of cash flows. Positive operating cash flow. Yeah, they had a massive acquisition. Let's see. Yeah. Okay. Because you can see they got a lot of money from debt. So they partially financed this acquisition with debt, and the rest they use their operating cash flow. Overall, it's not a bad business. It's just, what you're going to pay for it. So my question with Etsy is this revenue growth sustainable? Why did this revenue grow so quickly? I mean, look before the pandemic era. It was growing pretty quick, but this is like massively explosive growth. So why is it growing quickly? Is that sustainable? Will they continue to issue shares? Overall, I mean, I'd be interested in looking at this. It's not a bad stock. Let's see. Down 57%. Yeah, I definitely put that in my back pocket. Maybe I'll do like a more in-depth video. I am not that disgusted with this stock, which is pretty rare. PE of 26 for price to books 15. They do have a lot of goodwill and intangibles. That's what I would worry about that a little bit. Price to free cash flow, nothing crazy. Debt to free cash. I mean, they don't have a crazy amount of debt. Let's see. Yeah, I mean, I don't hate this company. I don't think it's going out of business anytime soon. Definitely something I'd be interested in looking at. All right, not a bad play. Don't know 443. It's better than honest, my bonest. I can tell you that. Let's see. But it's profitable, strong man. Inventory equals homes. Yeah, I mean, if they have that much, okay, I guess they're taking on debt. So that company we looked at, Open, they're borrowing money to buy homes in this freaking market. I don't like that. Let's see. Corporate home buying. Yeah, I don't like that. D-Dog. Raw Dog. Let's go check out D-Dog. D-Dog, my hot dog. Data Dog. Okay. Well, market cap of $33 billion. Pretty low net income versus revenue. That's like really low. What do? They provide monitoring and analytics platform for developers, information, and business users in the cloud. Software as a service platform integrates and automates infrastructure monitoring, application performance. I don't understand this mumbo jumbo. Okay, some kind of tech company. Great. Let's see. Massive revenue, my avenue. Revenue, my avenue. Oh, yeah. Let's see. Probably a high gross margin. Yeah, not surprised. And let me guess, guys. They have a very high share compensation expense. Let's go look. So they're unprofitable. I wonder why. Oh, and they have high free cash flow margin. Well, first, let's see if they have a lot of fixed assets. Because like I said, the two big non-cash expenses I've noticed obviously are depreciation and share-based compensation. So they don't have a lot of property, plant, and equipment, and they don't even have a lot of intangibles relative to their total assets. So I'm going to hazard a guess it's share-based compensation. Look at that. Share-based compensation is why they are unprofitable. Another stupid tech company with share-based compensation. I don't like that. I don't like that, guys. I don't like that, okay? So their share-based compensation is $163 million. Okay, it may not be that bad. Am I looking at that correctly? 15% of their revenue goes to share-based compensation? Oh my God. No. It's so easy, guys. You literally just look at the income statement and you compare profit margin to free cash flow margin. If there's a huge difference, there's a big non-cash expense in there. In this case, it's share-based compensation. And how did I guess that? Freaking tech companies, man. I hate them. No, I'm not doing that one. Jesus. You people in your freaking tech companies. GoPro. Oh, we need to look at GoPro. When did Lufufu buy GoPro? Here, let me close this. Didn't he buy it in like 2017 or something? Like lose his ass. I'm Jimmy V. Bro. All right, let's look at let me see the ratios. I'm trying to think when Lufufu. Okay, yeah, he must have bought it in 2016 or 2017 because you can see the market cap got freaking wrecked. So of course, Lufufu bought it probably when the market cap was $1 billion, and it has never returned to that except for 2021 and 2020. Good job, Jeremy. Let's see what he loved about this company so much. What does GoPro do? I wonder what they do. If you don't know what a GoPro is, it's just like a camera you strap on your helmet, basically. I'm sure they do more stuff like software and whatever. Okay, so basically before the pandemic, they had flat revenue. And after the pandemic, they had flat revenue. So when you project revenue for this company, you need to grow it at 0%. That's what I would do at least. I mean, look at that revenue. It's like Almost predictable. 1.18, 1.17, 1.14, 1.19. Their revenue's flat. They're like peaked out. What is their PE ratio? Oh, 2. Okay, yeah. It's because their freaking revenues. Like, this is like it's not a dead company, but I mean, how are they going to grow? Let's see. Are they profitable? Okay, gross margin, kind of in the mid-30s. I would discount that 41. Operating margin, okay, they've been unprofitable. When did Jeremy buy this? 2017. What was their profit margin? Negative 15%. Oh, Jeremy. What is wrong with you? This is garbage. Okay, they have no revenue growth, and their freaking profit margin is negative, except for 1 year. They've had negative operating cash flow, except for the last 2 years. Free cash flow. Okay, they just started generating free cash flow. Let's go look at their balance sheet. Long-term liabilities, 169 million. Long-term assets. Okay, I guess they're not doing that bad in that regard. They have a pretty decent balance sheet. I can't really hate on the balance sheet that much. This is garbage. I mean, what is there to like about this company? Honestly, what is there to like? Nothing. Good job, Jeremy. Bias course, 20K. Hey, Strongman, what do you think of Naspers now? They are selling 10 cent my instant to buy back their stock. They sold 10 cent? Disgusting. Etsy's a decent company. I agree. It's not that bad. Of course, Jeremy won't buy it. It's profitable. I checked GoPro, Bob. How many times do you want me to check GoPro? Let's see. Garza's a grifter. Thoughts on Costco? I think Costco's massively overvalued. We can go look at it real quick. I'll show you why I think it's overvalued. This is so hard, guys, okay? Costco. Costco by Roscoe. So Costco, make sure I'm sharing. Costco has an extremely low profit margin, okay? It is very, very low margin. And you look, I mean, they do have decent earnings per share growth. Like, I'm not going to dispute that. That's pretty good. 16, 9, 24. They're growing their earnings at a pretty healthy clip. But it's a very low profit margin business. And it just takes one, increase in inflation. It looks like they haven't really been affected by inflation that much. But actually, let's see the quarterly. They've actually been able to maintain their profit margin with inflation. That's actually not that bad. But at the end of the day, I don't like these super low margin businesses. They're so close to being unprofitable. You're just taking a huge risk. And look at the free cash flow. Like, their free cash flow margin is low. It's like almost nothing. Then you look at their price to earnings. Well, how fast is their revenue growing? Okay, look before the pandemic. 7%, 9%, 9%, 8%. Like, they're not growing that fast. And then you go look at their ratios, their PE, 37. 37 for a company that's growing revenues at 7 or 9%. I mean, 2021 is probably an outlier. Really? That just screams overvalued to me. I don't like it. What's the price to free cash flow? 52? I mean, they got a good balance sheet, it looks like. They're not in a lot of debt. And they have a pretty decent current ratio. I don't know. It's a great company, but I think it's way too pricey. I would wait for this thing to get freaking wrecked, and then I'll potentially consider it. But, Charlie Munger, my hunger, he likes it, but he probably got it at a good price. APT. This better be profitable. This better be profitable, boy. APT. Alpha Pro Tech. Sounds like a douchebag company. All right, they're profitable. That's great. What do they do? A range of disposable protective apparel, infection control, and building supply. Okay, guys. How much you want to bet they had a massive revenue explosion during the pandemic? Oh, look at that. No, come on. Look at that. 46 million, 44 million, 46 million, 46 million. Pandemic, $102 million. No, just no. I mean, what's the profit margin? Okay, and look at their profits exploded during the pandemic. Like, this is basically a dead company. Like, it's not growing revenues. They were a beneficiary of the pandemic. This is an obvious not buy, in my opinion. No, come on. I mean, they just make gloves. We can use them as a condom, maybe. I don't know. No, I wouldn't buy that company. Sorry. You should have bought that before the pandemic. Let's see. Have you done a video on DocuSign? Let's go look at DocuSign. I'm not a genius investor. I just avoid stocks that I think are even remotely overvalued. If I find one thing that I don't like about the company, I'll just buy an index. Simple as that. All right, DocuSign, massive revenue, my revenue growth. That's great. Unprofitable. Let's see. Oh, low profit margin, high free cash flow margin. What could it be? Do they have a lot of property, plant, and equipment? Not really. Could it perhaps be share-based compensation? Man, how do I predict these things? It's almost like I'm a genius. Okay. Share-based compensation, $408 million out of how much in revenue? 408 divided by 2107. 20% of their revenue is expensed away on share-based compensation. You guys, it's really simple. Look at their profit margin. Look at their free cash flow margin. High free cash flow margin, low profit margin, probably share-based compensation or depreciation. But with these like techie companies, they're not going to have a lot of depreciation. This is no, stop. How much is this sold off? 76%. I mean, I'm not saying like some of these companies can't like go up massively, but holy freaking crap, man. Costco going to jack their margin from 2 to 3%. I mean, it's not a bad business. Like they didn't have margin compression. Oh, it's so very official during inflation. So I mean, that's pretty good. Kevin had to sell his real estate portfolio to pay taxes, so basically no real estate wealth. Taxes will kill you, man. All those stupid freaking whatchamacallits. I missed a super chat. Are you lying to me? Did I get a super chat and I didn't see it? Somebody's messing with me. I don't see any super chats. Out of breath there. 10-cent music. Thank you, Hedge App. I feel rich now. I'm glad I saw that. I would have felt bad, but sometimes they don't pop up. I don't know why I typed your name in. 10-cent music. I'm sharing my screen. Okay. Let's see. China stock, probably. Operates live streaming services in the People's Republic of China. Aren't they communist, guys? I mean, they have like stock markets and stuff, but they're communist, bro. Let's see. Growing revenue, my revenue. That's good. Okay. Gross margin. I mean, I guess kind of low for, I don't know, maybe they pay a lot of money for the music. Decent profit margins. I mean, they had a decline in profit margin. That's probably because of the whole crap show going on in China and around the world. Let's see. Balance sheet. A lot of cash. Not a lot of short-term debt. They're not going out of business anytime soon. Long-term assets, 40 billion. This is probably in Chinese currency. Yeah. Okay. They have a lot of goodwill. I'll tell you that. They have a lot of goodwill. They also have these long-term investments. I don't know if this is like them acquiring other companies or if this is just them plopping money in like bonds or something. It's probably them buying partial ownership in other companies, which is fine. Let's see. Let's go look at their statement of cash flows. Yeah, those long-term investments are acquisitions. So they have growing, decent operating cash flow. They're making acquisitions. Are those good acquisitions? I don't know. They bought back shares. Okay. Let's look at their ratios. PE 20. Let's see how fast are they growing. I mean, their growth is like their revenue growth is declining pretty significantly. Like I said, I don't know if this is just because of the whole crackdowns and crap in China, but when it comes to Chinese stocks, you have to factor in the China risk and the delisting risk and stuff like that. But if I were looking at this company fundamentally, which I am, I mean, it seems okay. It's profitable. It looks like it's buying back shares. Their gross margin is shrinking. Their profits are shrinking. Like I said, I don't know if that's because of the crackdowns or what, but they're not going out of business anytime soon. They are buying other businesses. I mean, it seems it couldn't be that bad. You have to do more research. But no, it's not horrible. I've seen worse. Okay, I've seen worse from people. So, not bad, guys. Not bad there, hedge app. All right, what else? Take out my dip. You guys ready for this? Mm. I could do this live. I love it. Click my dick. Let's go look. What's click my dick? It's better be if you guys give me unprofitable stocks, I'm just gonna like dismiss them. Okay. I want somebody to give me like $100 super chat and give me like a trash stock so I can look at it for like 2 seconds. Let's see. What is click my dick? Kulik and Sofa Industries. Oh yeah. What is this, like a Turkish stock? Sells capital equipment and tools used to assemble semiconductor devices. Interesting. Because, semiconductors are all the freaking rage. So my concern with this right off the bat would be anytime something's all the freaking rage and anything associated with that's all the rage. And we had a whole semiconductor shortage and, oh, everybody, we need a Bitcoin mine. We need semiconductors. I don't know how much this has been affected by that. No, it's basically traded flat. Okay, it had a massive run up during the pandemic, and now it's trading flat. Okay, look at this. I mean, I'm not a chart reader, but holy freaking crap, man. Okay, semiconductor shortage, massive explosion, and it's still way above its like actual growth trajectory, just from like a it's stupid ghetto whatchamacallit analysis. Okay, look at this, guys. No, no. Look at this revenue: 809, 889, 540, 623. Kaboom! 1.5 billion. It's got to be because of the semiconductor shortage. That's got to be what's causing this. Let's see. Yeah, this could potentially be in a massive freaking bubble right here. Let's see. Profit margin, kind of low margin. They had one good year. I don't like it. I don't know. Let's see. Yeah, I don't know. I don't like this. I don't like these stocks that like freaking run up massively, and they're the beneficiary of like a certain trend or whatever. I can see this stock getting freaking wrecked. I mean, maybe it's a buy when it goes back down to like 15, maybe, but no, I wouldn't touch this freaking stock with a 10-foot pole. 10-foot pole. 10-foot pole. Let's see. Check under your hat. There's a gift. Ooh. Is that your essence? Let's see. Okay. What else? User of Sharingan's in the house. Buy Tencent. They have a 5% in Tesla. I've never seen a more bullish thesis for Tencent in my life. I might sell Tencent now. I have $1,000 in Tencent. My basis is like 56. I've gotten my cheeks clapped, but so have all Chinese stocks. Yuck, unsubscribed. Yeah. Let's see. Hello, do an analysis on Pokemon. Nintendo. Oh, it's Gaming with Cole. Go subscribe to his channel. It's actually pretty good. Even though Cole thinks I'm a grifter, I still love him. Let's see. Nintendo. Nintendo, my Schlindo. What's happened to Nintendo? Okay, Nintendo's gotten wrecked. 67 down to 53. Okay, yeah, I guess the data's not feeding here. Let's see what's going on here. What? What is this? This is what happens when you use free stuff, right? There's no Nintendo. Well, based on this income statement, I think you should put your entire life savings into this. Well, I guess we're not analyzing Nintendo stock today. Let's see. Boom, 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 boom. Willy Wonka? Willy Wonka and the Chocolate Factory? Hello, mate. I'm from England. Willy Wonka? You like that? Strongman, do cash flow for Pokemon. Only 25 subs. You need to stop starting new channels, Cole. Get your one channel over 1,000, then you can start a new channel. Nintendo will jump when my channel blows up. Maybe maybe Cole was bullish. Or Cole my butthole's channel is bullish for Nintendo. AFL, American Fellatio League. Let's go look. That's pretty good. AFL. Aflac. Oh, I'm not really great at insurance. I mean, with insurance, it's like, I don't know. Are you an actuary? Do you understand how well this insurance company is managing risk? I don't understand insurance that well. I mean, I know the whole concept of insurance is you collect more in premiums than you do in payouts. And I'm sure there's a way to analyze these companies. But I don't know. I mean, we can look at the growth. All right, flat revenue. Let's see. Decent gross margin, very profitable. Okay, I like that. So it's basically a value play. I mean, it's like a value play, you know. Okay, yeah. PE of 9. I mean, this company, I mean, just right off the bat, it may be a buy. I don't know, but I don't really like insurance. I don't understand it. But as companies go, this isn't that bad. I mean, they're just not growing very quickly, and their PE reflects that. I mean, obviously, look at that 9, 8, 6, 11. I don't know. I don't know what to say about that, man. I'm not an insurance guy. I don't do insurance. Insurance financial advisor. DFS. I can't even say a bad name for that. DFS. Discover Financial Services. Financials. Provides digital banking products. Digital banking and payment services. Let's see. Let's go look at the ratios. PE of 5. Okay, this is like all over the place. I mean, look at their growth before the pandemic. 7, 7, 7, 7, 8, 6, 11. Is this organic growth? Like, what's going on? You see that massive difference? That's odd. Did they acquire a company? They didn't have any acquisitions. Okay. Where's that revenue growth coming from? I don't know. Cash and cash equivalents, 11 billion. Okay, it's missing data. What is wrong with this? Book value per share. Okay, at least they're growing their equity every year. That's good. I mean, it doesn't seem that bad. I don't know. This thing is like missing data. Look at their gross margin, 100%. Profit margin. Yeah. They got schwacked during the pandemic, man. Look at that. That's freaking crazy. I don't know. It could be a buy. I don't know. To be perfectly honest. It's kind of all over the place. All right. One or two more. I'm getting freaking tired. Oh, God. I can't put that up. Ticker symbol D's nuts. Check out Crocs. All right. Let's go look at Crocs. Everybody's talking about Crocs by Thunder Cox. Let's go see. Crocs. We have a lot of debt. Crocs. Doesn't Diamond Hands investing like this? It's probably trash. All right, let's see. What does Crocs do? They sell really weird looking shoes. Okay, revenue 1.2, 1.3. Massive explosion in revenue. Why? Let's go look at their cash flow. Did they acquire a business? Okay. Yeah, they had a huge acquisition. Huge. Let's see how much goodwill came from that. Oh my god. Look at that goodwill. 2.5 billion, and they acquired. Wow. Yeah, they did buy a company. I remember reading that somewhere. That's crazy. That radically changes the business. So I don't know what company they bought. You'd have to go look at the financials of that company and kind of like separate them. You know what I'm saying? Like you'd have to look at Crocs by itself versus Crocs, the frickin' or whatever they acquired. And you'd probably have to model those separately to see, what the consolidated entity would be. But yeah, I don't like explosive. Like I said, I don't like explosive revenue growth like that. That's just, to me, that's like, what's going on here? But that's probably from the acquisition. Okay, they're buying back shares. Let's see. Very good gross margins. Okay, they were pretty unprofitable for a while, but now they're very profitable. Good for them. Let's see. Let's look at their balance sheet. All right. Look at they took out a decent amount of debt to finance that acquisition, it looks like. Let's look at the quarterly. Oh my god. See, you gotta click on the quarterly. Look at that debt. They went from $920 billion to $920 million to $3 billion of debt. And this is during a rising interest rate environment. Like, holy freaking crap, man. And most of that debt went to goodwill. No. I don't like this. Look at that. That's insane. They basically just like massively overpaid over the fair value of the net assets for this business they bought. I wouldn't know. You don't want to buy a company with a lot of debt as we're going into freaking a rising interest rate environment. Any apportion plays? Oh God. Boom 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 boom. All right, last stock. Thank you, Transforming Money. Let's go look at Disney, my schlizney. Disney, my schlizney. Disney. Well, excuse me. Diz my is. All right, what does Disney do? I wonder. All right, let's go look at their revenue. My Avenue. 55, 55, 59, 69. Actually had decent revenue during the pandemic. 67. I think they'll have decent I would probably grow their revenue at the rate of the growth of the economy. Or inflation, 3, 4, 5%, something like that. Disney has very strong brand awareness. Okay. I don't get the whole Disney thing, by the way. Be like, oh, we need to go to Disney and just get ripped off massively because our children need to go. You know where I'm going to freaking Gatorland. You know where Gatorland is? It's in Orlando. Okay. Instead of going to Disney and getting ripped off, you can take your kids to see a bunch of freaking alligators. And it's like $30 to get in per person. Way better experience. And if you don't like the kid, you can just toss them in with the alligators. Okay. What was their profit? Let's look pre-pandemic. Yeah, they're a pretty profitable business, man. They're obviously their profits are trash right now. These last couple of years, that's obviously because of the pandemic. But you look in the past, they're very profitable. Let's see what their PE is. Price to earnings. Okay, they have a very high price to earnings, but remember, that's because their PE is 66. But if you go back and look, the market's pricing in these old profit margins back here. They're not pricing in this. So just because it has a high PE doesn't necessarily mean it's a bad play. Let's see. Balance sheet. Is Disney going to go out of business? 13 billion of cash. 29 billion of current liabilities. Well, they got receivables too. $31 billion of current assets. Okay. I mean, they're not going out of business. Their current ratio isn't the best, but I don't think they're going out of business anytime soon. Let's go look at their current ratio. Yeah, they're not going out of business. Debt to equity going down. Have they been putting out a lot of debt? Let's see. Okay, not really. They're actually, yeah, they're paying off debt. Looks like a little bit. Their debt's going down just a tad. That's fine. Let's see. They have 78 billion of long-term debt. And looks like they have a lot of goodwill, but I mean, it's Disney. Okay, they probably bought a bunch of freaking franchises that are going to be around forever. Let's see. Decent operating cash flow. Honestly, I'd have to model this out, but it may not. Oh my God. Hold on a second. Yeah, I'd have to model this. It's hard to tell. Like, it has a very high PE. That's for a reason. I wouldn't automatically discount Disney. I mean, they're not. Okay, they do have a decent amount of debt. They actually have a lot of debt relative to their free cash flow. And you look at their return on invested capital, and it's pretty good. Yeah, honestly, I'd have to model this out. I can't really tell you. I mean, it doesn't seem that bad. How much is it sold off? Woo! Lordy. Woo! I mean, damn, just looking at that chart right there, it don't seem like it's that bad because it's dropped 7% over 5 years. And the business has gotten a lot larger. I mean, look at the revenue over 5 years, 55 billion to 67 billion. The only thing that screwed it over, obviously, was the pandemic. And let's see, when did they take on a lot of debt in one of the quarters? Let's see. No, looks like they've always had a lot of debt. Let's look at the annual. Okay, yeah, they had some massive explosion in debt from 2018 to 2019. What was that for? For an acquisition. So I don't know what they acquired, but they took out a lot of debt for it. But at the end of the day, like, yeah, it actually might not be a bad deal. Actually, I'm interested in looking more into this. I mean, you look at the 5-year chart, man. This is one of those things that's like, okay, over 5 years, this business has grown pretty massively, and it's down 7% over 5 years. It might actually be not bad. I don't know. I have to go look into it. I'll definitely check out Disney. I might do a dedicated video to it. All right, well, that's it. Disney puts out trash. That's relative. I mean, they have growing revenue. Yeah, their PE's high, but that's because their last year was garbage. It might not be bad. I mean, I'm actually interested. Let's see. Star Wars, Marvel. Yeah, I mean, even if you don't like it, if people are watching it and they're paying for it, it might not be a bad deal. Oh, that's good. That's good. That's rich right there. You're going to eat your words. It's going to be true. LaFufu sold Bussy to Mickey Mouse. All right, guys, that's it. I'm freaking tired. Have a wonderful night. Cheers.